Greetings, my beloved clients. I wanted to get this video out to you. It might not be the most polished thing that I put out, but I think it's timely, reflecting on how the markets have been behaving in the last week or so. We wanted to get this out to you. So the title of this message is A Word About Risk. So I want to talk to you about our firm's approach to risk and risk management and how it is how it is distinct from what you would hear from many other investment managers and analysts. So within the investment management industry, there are basically two schools of thought when it comes to risk and risk management. And the one school of thought would be the modern portfolio theorists, which includes most academics and most analysts. And the other school of thought would be what Warren Buffett calls the super investors of Graham and Doddsville. And it would be the adherents of the teachings of Benjamin Graham, who, if you've been around with me for a while, you've heard that name. And he wrote the book The Intelligent Investor, and his greatest disciple was Warren Buffett. And I taught a class for many years at the local college on that topic of the intelligent investor and Graham's style of investing. That's the strategy that I employ. And spoiler alert, I'll go to the end and tell you why. For one thing, the modern portfolio theorists tend to average over long periods of time about 8% returns, anywhere from 6 to 10% returns. And if you ask them, they'll tell you that's what the types of returns they expect. Whereas historically, these super investors of Graham and Doddsville over long periods of time have been able to beat the market and average any 16, 20, 24% returns. And for my clients who were investing long-term to secure a comfortable retirement, this is an example of how much would $100,000 grow when invested over 25 years. And at 8%, it'd be $684,000, which is a big difference compared to at higher rates of return. And when I looked at this, I was like, wow, I think the greatest value I could provide to my clients is to secure a retirement nest egg that looks more like this than this. And so when I saw the value of that, I really started to study the Graham model and try to implement within my portfolio. So let's get to the big difference between the two schools, and that is how they define risk and the fallout from that difference in definition. So let's open this up here. So first of all, how the modern portfolio theorists define risk is volatility, the ups and downs in the market we've been seeing in the last week. And the way they measure that is over a 1-year standard deviation. How much does it deviate from the norm over a 1-year period? And I kind of question, why do they even choose a 1-year period when, if I look at my clients, probably 10% of them look at their accounts every day. About 60%, the majority, probably look at their accounts about once a month when they get their statement. And the other 30% probably once a quarter when I call them and say, hey, let's take a look at your accounts. So why even measure for 1 year if clients are looking at their accounts on a daily, monthly, or quarterly basis? And when their goals are long-term, they're longer than 1-year goals, on average 15 years or more. So why even look at volatility over a 1-year period of time? So anyway, the super investors of Graham and Doddsville define risk as the permanent loss of capital. And that's measured through realized gains and losses. So if you sell something for less than you bought it for, you lost money. And that's the risk that we're trying to avoid, you losing money. We're not so concerned about short-term volatility. And how that plays out as a risk management philosophies really makes a huge difference. That simple difference makes a huge difference. And so for the modern portfolio theorists, their risk management philosophy would be to minimize volatility. That's their goal. We want to keep volatility to a minimum. Big swings in the value or the price of these assets. We want to keep that to a minimum. And the strategy that they would employ would be broad diversification. They want to own a little bit of everything so that any big price move in any one of those, hopefully it won't have a big impact on the entire portfolio. That's their strategy. And it has some drawbacks because the market is by nature volatile. And if you take that away, you're going to give up a lot of long-term return just to minimize short-term volatility. Compare that to how these super investors manage risk. Their philosophy is one called margin of safety. That's how they propose to protect the clients from a permanent loss of capital. If we're looking at an asset which we determined to have an intrinsic value of, say, $10. Well, if we could buy it for $5, that gives us a big margin of safety that protects us from any short-term volatility. And that, in a nutshell, is how we manage money. If you were to ask any investor that consider themselves a super investor, Graham and Doddsville, what are the three most important words in investing? They should tell you margin of safety. If you were to go to my house and throw up at 2 o'clock in the morning while I'm deep in a deep sleep and throw a cup of water in my face and ask me real quickly, what are the three most important words in investing? I should yell out margin of safety before I even wake up and have come to my senses. But anyways, so how do we manage risk? What's our strategy? It's careful analysis, thorough analysis on how to understand the intrinsic value of that company and to buy it when it's at a discount. And I don't want you to think that risk is not important to the super investors. If you ask Warren Buffett, his 2 rules of investing are: rule number 1, don't lose money. Rule number 2, don't forget rule number 1. The way Benjamin Graham defines investing is an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Safety of principal is his number 1 priority. They just go about it a different way through the process of margin of safety. Okay, so how would either group propose increasing their returns? Well, if you were to ask a modern portfolio theorist, what can you do to increase my returns? He'd say, well, the only thing we could do to increase returns is to take on more risk and to deviate away from broad diversification and maybe place some sector bets, overweight this, underweight that. And hopefully, even though we're taking some more risk, if we're thoughtful about it, we'll try to get you a little bit extra return. But they're getting away from their fundamentals when they try to increase their returns because they're getting away from broad diversification. It's something that they're not comfortable doing, and they only do it in small increments, and it really doesn't make that big of a difference. Now, compare that to how you would, a super investor would try to increase returns, and the answer would be, well, a bigger margin of safety. If I have a margin of safety by buying something that's worth $10 and I can only pay $5, what if I was able to get it for $3? It doesn't, granted that those type of opportunities don't come around very often, but when they do, and they present a bigger margin of safety, they present a bigger opportunity for growth. But guess what? They also give you a bigger margin of safety, or they actually lower their risk. So when you find a investment opportunity with a bigger margin of safety, not only does it give you potential for increasing returns, it also lowers the risk. And that's way different than the modern portfolio theorists. They think you have to take on more risk to get higher returns. So when we see an asset, like when I saw Tesla last year, it was something that doesn't come along very often, but we saw this thing had a huge margin of safety. So what would you want me to do when I see those rare opportunities when the margin of safety is bigger than normal? Well, just put 1% of the portfolio into it? No. In our portfolio, we have about 20 positions, and on average, a company with a nice, comfortable margin of safety, we might put 4% into that. But when we see one with this really big margin of safety, we're going to load up on it, put 5, 10, 15, even 20% of the portfolio in that, because it gives us a bigger margin of safety, which means lower risk and higher returns. So that's our approach. We're definitely trying to protect you from a permanent loss of capital. We're not so concerned with short-term volatility. So let me give you an illustration to kind of bring this home. If you've ever had any training firing a weapon, there's a couple things that are just basic principles. One, so you want to hit the target, you have to make an alignment of your rear sight, your front sight, and the target. Once you get those all in a line, you're on target, right? And so, and when you do that, there's some you're looking at 3 points in a line, and the eye cannot focus on all 3 of those points simultaneously. So the method that is correct on firing is, you're going to see this rear sight, it's going to look hazy. The target is actually going to be hazy, and your focus is on the front sight. Okay? So investing is a lot like shooting. There are 3 things that we need to line up, and we're looking at current events, but our main focus is 10 years out. And then the ultimate target is your long-term goals. So I always have an eye on those 3 things. I'm looking at current events, but they're a little bit hazy, to be honest with you, when I'm looking at it. I'm really focusing on what's the world going to look like 10 years out. And I'm also keeping an eye on your long-term goals, which is the target. But that's a little hazy. My focus is 10 years out. And by doing that, we should be able to hit the target, which is achieving your long-term goals. So here's what a bad shooter would do. They would focus on current events, right? And especially when current events are making a lot of headlines, what's going on in Washington or the stock market or whatever. It's not that important. That's not the thing that we should be looking at and have our focus on. And sometimes people will look at current events and totally forget their long-term goals and not even consider what's happening 10 years out. That's not the best way to hit the target. A couple other things that we are taught in shooting is, one is to focus our sight on the 10 years out, but also to control your breathing. And as you breathe in, that front sight tends to float up a little. And as you exhale, that front sight dips down. And you want to, as that front sight dips down, you want to let it land right in the center of mass on that target. And then between your exhale and the next inhale, there's a natural pause. And that's when you squeeze the trigger. And how does that relate to investing? Well, we need to control our breathing and not panic and not get jittery, right? We need to be able to focus on our breathing, not panic, keep our eye on that 10-year time frame, and we should be able to hit the goal, right? A nervous investor would elevate their heartbeat and be breathing panically and wanting to squeeze that trigger over and over again, buy and sell, buy and sell. Look at the current events, right? That's the opposite of what you want to do. We're looking at current events, but we're looking through current events to 10 years out and to your long-term goal. We're relaxing, we're controlling our breathing, and all we need is 6 pounds of pressure on that trigger to release that round and send it downrange and to hit your long-term target. And so here's the shooter, that's me. Here's the spotter, that's you. And here's me looking at current events 10 years out and your long-term goal. What's the spotter looking at? He's only looking at the long-term goal. And if you could lay there in the grass beside me, focusing on your long-term goal. Let me look at the current events, what's 10 years out, and your long-term goal. We could work together to hit your long-term target. Okay, so I hope that helps in how we approach risk. And once again, by focusing on margin of safety, it opens the door for us to invest long-term, not worry about short-term volatility, and try to get you the long-term results that are going to make a big difference in your retirement. Two roads diverged in a yellow wood, and I chose the one less traveled by, and that made all the difference. So yes, the road of the super investors is the one less traveled, but I think in the end it's going to get you to a much more beautiful long-term retirement destination. So feel free to, like always, I welcome any questions or comments regarding anything we discussed, and feel free to share this with your friends and relatives that are interested in investing.